Welcome, traders. It's time for Market Matters, brought to you by Max. I'm your guy, Joe Teagay from Equity Armor Investments. As always, my trusty companion, Brian Stutland, is here too. And thanks for tuning in today because, boy, we got a big week ahead. Picture this. It's not just an ordinary week. No way. It's the most important week of trading ever in the history of trading. We've got more action-packed events than a superhero movie. First up, we got the Fed making some big decisions. They'll have a press conference too. And then hold on to your hats because we got some heavy-hitting economic news with the jobs report, manufacturing data coming in hot too. But wait, there's more. We're topping it all off with some real heavyweights in the tech world stepping into the ring. We're talking about 5 of the Magnificent 7: Microsoft, Meta, Apple, Amazon, and Google. Oh, man, these guys are superheroes in the stock market, and they're all reporting this week. But fear not, Brian and I are here to be your trusty guides. We'll take you through this wild trading week. We got tips, tricks, real-life examples to show how to go through this week. So buckle up. Hold on to your trading caps. Let's dive into this epic week together. By the way, thank you all for joining in. Everybody here, really means a lot to me that you're here. Feel free, shoot me a question, leave a comment. If you're watching this later, like and subscribe. All that will be super beneficial. I was talking about these economic reports. Whoa, big data coming this week. The jobs data is always big, to say the least. But, we got the JOLTS. That's been big this year. We also have the ADP. That'll be a big one. The Fed policy decision. That's really exciting. That's coming in on Wednesday. We got initial claims, manufacturing PMI, topping it off with Friday's non-farm payrolls. What a week, Brian. I can't hear you, Brian. I'm sorry. Your mic's not. Maybe it's my sound. I can't hear you right now, Brian. I'm sorry. You're coming in. Not yet. I'll check it. Well, I'll check with you in a second, Brian. Well, this is the magic of live television. Bear with us, folks. We got I mentioned we got these earnings reports coming out. I usually put up all the earnings report. Now, besides these companies, there are a lot of earnings out there. AMD is out this week too. But we got 5 of the Mag 7. Here they are. Apple's going Thursday, Meta Thursday, Microsoft Tuesday, Amazon Thursday, Google Tuesday. Whew, what a busy week we're going to have here. Brian, how you doing? Yes, I can hear you. Now I can't hear you. I can't hear you. Sorry, Brian. Oh man, I'm sorry. So very busy week. Let's look at these implied. And by the way, take a screenshot of this. This will be really important for the trading week ahead. I got up here the implieds versus the historical move. Very interesting to see Apple very, very low implied volatility into this event. Meta also very low. Only Google and Microsoft here have higher implieds than the historical move. I usually see the opposite. I usually see the implied moves higher than the historicals. So that is interesting. Also volatility is relatively low out there. So there's a couple of things. Apple's got a lot of fascinating stuff out there. And by the way, these are huge companies. You may not own them, but if you own any equities at all, you own a piece of these companies. They're making up 30+% of the S&P 500. So these tech in general is 30% of the S&P 500. But you guys, everybody owns these stocks, whether they know it or not. And this is going to be a pivotal week, to say the least. Apple's got its questions. Are these iPhone sales going to ever disappoint? Are they going to get enough from China, which only recently got their economy jump started? Meta is Facebook. Are they going to be able to continue this? They're going to be able to lean on this AI for the foreseeable future. We got these corporate action suits coming up against Microsoft and Google. Amazon just had to take down one of their mergers with because of an EU regulation. So a lot of question marks here. We'll get into more of that as we go on. The investor sentiment we like to talk about every week. This is actually trending in the right direction for bulls. We're not offsides here. Everyone's not all in on this long the market craze. And Brian, you're back. It's good to see you.
I know. Maybe when I start talking this time, you can actually hear me. I think
yes.
All right.
That's third time's a charm. Live TV is a miracle. So I went through the whole week ahead. Very jam-packed week. Talked about the earnings. We got 5 big earnings right now. 5 big companies earnings out there. Maybe there's some smaller, important ones. Don't sleep on AMD, things like that. But this is the investor sentiment, Brian. I'm not seeing anything that is going to give me a big directional shift one way or the other. Are you seeing anything in the fear and greed index?
Yeah, I mean, we like to look at this because this index produced by CNN actually, incorporates our volatility indices in there, along with sentiment, market movement, momentum, and certainly this is looking like a market that's been somewhat overbought. So there's reason to be a little bit cautious here. We're heading into a month in February, and Joe, you can maybe talk a little bit about, sort of the sentiment and seasonal trade here, but when you talk about a greed index here now pushing up towards the high end, this is usually when you want to be a seller, maybe take some profit. We still like being long the market, but we're now looking to try and add some hedges here, up our, protect, I should say, our downside exposure at this point. And we'll talk about this later in the show, how we plan on doing that.
Yeah, just a quick reminder here. Remember last summer, July, the market was on a high. People were more extra greedy. And the market was kind of on the low last October. People were fearful. So it's something to pay attention to. And it kind of coincides right now with the seasonality timing aspect of the volatility. Something we've been talking about lately. February and March, we start to see volatility pick up for the rest of the year. And such a pivotal week, we're talking about, it sounds silly to be this hyperbolic, but, we got the end of January, so January goes the rest of the year, all these events. And, we might have some volatility right around the corner. And, the Fed is going to be kicking it all off on Wednesday. They've got a big job to do. Now, people might be sleeping on the Fed because we're not expecting the Fed to change their interest rates. However, Powell has done a great job, Brian, the past couple of years. Even though they've raised rates very sharply, they've been in line with the market ahead of these meetings. They've not caught the market off guard on any of their hikes. So the expectation into the event that the market had is exactly what the Fed does. So they've telegraphed what they will do. And right now in March, the market doesn't know. It's 50-50. Cut or no cut. So it's a very pivotal week for the data and for the Fed. And people will be looking at their statement and their press conference very closely.
Yeah, I mean, you open up the show like this is the biggest week of trading ever, but it really is going to be a remarkable week. I mean, you're talking about Fed rate, are they going to cut? Are they going to stay or what? We've got a 50-50 chance going either way the market expects it. So once they give an indication after this meeting, I expect the market to really react off of that. Given this, middle ground waiting here, like you said before, in the past, they've telegraphed it really well. Now we're sort of in I don't know zone. Couple that with all the earnings of the big, Magnificent Seven or whatever you want to call it up this week too. There really should be some huge moves this week. And so I want to be prepared for that. I'm starting to reposition the portfolio and take a look at it. We have a strategy ourselves where we own NASDAQ. We want to be tech savvy here. We think those are the leaders in the market, but we stay hedged. We call that our NASDAQ, hedged equity strategy, surprisingly enough. But we think that's a cornerstone position in the market, especially right now.
Yeah. So we got the Fed on Wednesday. Got a lot of economic data this week too, Brian. Don't sleep on the jolts. Now, people, maybe they don't think about this as an important indicator, but we're trending very negatively on the jolts now. I know this came off of a super high level when people were just scrambling, looking for anybody to fill in, during after the COVID craze when people were just hiring like crazy. But take a look at where the job fallings or the lack of openings are now, the decline in the job openings are versus the previous 3 recessions. Starting to look a little similar. If we get more pullback, I'd be kind of cautious. Maybe this is a sign soft landing's not quite here. Recession is closer than we thought.
And I mean, this is echoing the move in here is echoing the sort of navigating through the interest rate environment. I think this is why we've seen the 10-year note and interest rates, why it came all the way back down to 4%. There's been some real concern about the job openings, and is our economy sort of slowing down and shifting, and is there some risks there inherently? And that sort of stopped the rate hike idea going forward. So it'll be interesting how much the Fed actually is looking at some of these numbers here to try and provide some liquidity in the system, because we've seen the M2 money supply shrink. We've seen the Fed wanted to take things off the balance sheet, and now we're seeing a little bit of weakness in the job picture. So it should be a really interesting meeting and see how much of this data gets digested, because obviously that number too coming this week as well.
Yeah, and manufacturing again, more weak data. Is maybe a leading indicator, but people, let's not sleep on this. We got, when we get this down here, this is contraction territory. If we see a number below 45, that's like serious contraction territory and something we'd have to be worried about. Now, this kind of couples with like the soft data and the Fed needing to cut, but we'll see how that plays out. And finally, the big one, jobs data on Friday, the unemployment rate. This is the one chart that it just seems really fine right now. It seems like, there's no unemployment problem, and it rises very steeply when we do hit a recession. But if you go back in time, you look at these previous recessions, right before the recessions, it kind of felt like it does now. It doesn't seem like there's much of a problem right ahead of these recessions. Doesn't seem like anything is imminently about to collapse. And then very suddenly it shifts in a hurry.
Yeah, and that's probably one reason to own volatility, to own some protection right now. We see the basing, but really if you take out that big spike from COVID, right, and just normalize it, you still get this sort of basing, bottoming process here in the unemployment rate, and any tick up from there has usually led to significant amounts of volatility and some sell-offs in the market.
All right, let's turn it to earnings. Boy, big earnings this week. This is the final piece of the huge week we have. Magnet 5 of the Mag 7 going this week. A huge chunk of the market earnings this week. And this is something that I just found fascinating. Most of these names are tech. Maybe you can argue Amazon's not quite tech. But if you look at the S&P 500, if you look at the percent of tech that's the S&P 500 weight, that is white. So like the percentage that technology is of the S&P 500 has gotten bigger and bigger lately. And the percentage of those earnings of the S&P 500, had been kind of trading line step in step with it. As that went higher, so did the percentage of the S&P. It became, but lately, last year, we've kind of seen this like disconnect. We haven't seen the earnings come lower, a lower percentage of the S&P 500, yet we saw the percentage of those companies higher in the S&P 500. So this is setting up some potential risk for me into these big earnings events.
Yeah, I mean, we kind of set up a bunch of things where it could be bearish out here. We could be headed in for some volatile times, maybe a little bit of a correction. But here's the silver lining to the stock market right now is we have seen these big tech names, Joe, really spend, NVIDIA basically being the one group, maybe now AMD going forward as a couple names that are really benefiting from it. But there's been a big spend by those big name type tech companies to sort of get into the game of the AI play, of cloud computing. And so maybe this is just a one-time spend, right, Joe? Like maybe they just spent a whole bunch of money here in order to keep up, and now their earnings will start to grow into it. That would be a positive time. I mean, we could probably circle back to how that looked in 2000 when the tech bubble burst, but there you had hundreds of companies spending and only a handful were going to survive. Now you just have a handful of companies spending, making up this big portion of the S&P. And I really believe their spend will come to fruition and that they'll actually grow into some of this spend. Now, obviously, if they're spending, the PE doesn't look as good for them. The earnings picture doesn't temporarily look as good. But if you look out going forward, 2025 and beyond, I still like the picture of it. I think it's the beauty of it. I think you need to be in this NASDAQ 100 kind of area of the market.
Yeah, I mean, that's got to be the case for me. Analysts are saying, the earnings are suppressed now because they're pushing it forward out into a couple of years once this AI thing really gets up and running. It's been the benefit of NVIDIA, to say the least. But yeah, we're seeing stretched valuations here. We're seeing EPS, at very high levels. Now you got to go back to the .com bubble actually to see higher tech PE. But these are areas, go back in time when historically it's been just a little too lofty and harder to see it continue to rally. Now the other, it's certainly possible that these companies, can bring the PE down by just increasing their earnings. We'll have that. We'll get some info on that this week, obviously. But it's certainly at a spot where it's a lot harder to see these PEs get any higher from here.
Yeah, and I think that's why when we look at the earnings, Joe, and we sit on these conference calls and listen or watch the news wires hit on what they're sort of looking at, it won't be so much the numbers today, but their guidance going forward. I think that's how the market will react to these companies the most. And so that's something we'll be paying attention to is, can they sort of grow into this spend and grow their earnings? And if they give indication that they can, I think the market will like it. They'll reward it with higher PEs, and maybe we stay at the top end of this sort of PE curve of things.
But here's the bear case. Not that I'm a bear, just want to throw this out there. We got a lot of events this week, right? And maybe some of them don't go like we planned. Maybe these economic data points are starting to look a little ugly, or maybe the Fed says we're not cutting, until October, and maybe these earnings aren't going to be as good as we thought. The downside risk is there. So I think with that, we can take it to our trade ideas of the week, and let's take a look at what we're looking at for protection in these trade ideas for the week.
Yeah. Here's one thing. I was looking at the SPY, the Spider ETF, and taking a look at the charts here from a technical basis. We talked a lot about fundamentals, where sell-off could come, seasonality. We're not in a great spot for the market to continue to rally. We've gotten this sort of like really wedge type formation over the last few days, and probably a reason being the market is basically waiting for the Fed to decide and some of these earnings reports to come out. So the thing is after you get this tight wedge, you usually get some decent sized movement. If you look at the chart a little bit lower, we've had a couple gaps up where the market has just opened up and never really covered that gap. It just went to the upside. Those lower ranges down near 450 in the Spider are a concern to me, that we refill those gaps from a technical basis. And so I'd be looking to protect against the downside. Now, at the same time, on the bull picture, like I mentioned, we get some good reports from these earnings pictures. I think the market can go higher. I still have a price target of, let's call it 5,200 or so in the S&P. And if that happens and we move to the upside, I want to participate there as well, Joe. So what do I do?
Well, what do you do?
Yeah. One thing is a strangle, right? I can play both sides of the market. If I feel option prices are cheap enough where I don't mind spending some premium. Now, this premiums, they'll go to zero if we don't get outside of these strike prices. So I have to be watching this. This is something that expires on Friday, but I've been looking to buy the February 490 calls in SPY. I only spend $2.35 there. At the same time, I'll also buy the 485 put for $1.95. So the net cost to me is $4.30. I need the SPY, the Spider ETF, to move outside of 494.30 to the upside, 480.70 to the downside. That's about a 1.5% move in the Spider. I think a 1.5% move in this market is in the cards at the very least. Given all the news we're going to get, the digestion, at least there'll be some back and forth trading around this. I think we can make some money off of this, but this is how I kind of want to play a decent sized move coming to this week. I don't know, Joe, if you have any other thoughts on what to do. Like, do I stick with this trade? Do you like my trade? What do you think?
Yeah, sorry, I put 287 as the current price. Actually, 487. Wrote that in there. Hope nobody's confused there. So yeah, we're talking about spike index about 1420 this morning. So it's relatively low of volatility. We're talking about a volatility which we expect to start increasing this week. I think this is a very reasonable expectation to get a 1.5% move in this market. Now, I think come Friday, we'll have a lot more information. We'll kind of see where we are. Maybe Thursday, Friday, if we start moving upwards, if we get a good report of the Fed says we're going to cut We're going to cut in March, and we're going to maybe get 4 or 5 cuts this year. We race to the upside. I would start to look at selling the upside call. If we get this realized move to the upside, I think with these tech EPS is so high, I think that upside cap, there's a little bit of upside cap there. I'd kind of fade the upside, just collect a little more premium if that happens. Downside, just happy to watch this go and see what happens there. I think it'll be a lot more room to the downside, I should say.
Yeah, that makes a lot of sense. When you sort of sell a call maybe against a strangle rate, I'm going to pay $4.30 for this. So that's a decent amount of premium, almost 1% of the value of the stock itself, a little less than that. So Joe's kind of, pointing out a way where he can collect some premium after we've gotten the move before that volatility suck kind of comes out of the market if we should move to the upside. And the reason for selling a call probably, Joe, is you're thinking, hey, look at all this bearishness and this PE ratios lofty and whatnot. I'm not too worried about a significant move to the upside after this.
Well, I think there's a possibility that we should, be aware of, that we get great earnings. The Fed is dovish. The economic data is like Goldilocks, like with minimal inflation and strong enough economy, and yet the market still doesn't race higher. Just because these earnings, the EPSs are so high. So I think for me, it's hard to see higher valuations in these big tech companies. They're going to have to really up their guidance and really raise their game if the market's going to race higher in that case.
Sure, yeah. I would just cap it off as like when we look at our trades here, like I mentioned before, our NASDAQ hedge equity trade, it's not exactly something like this exactly outlined, but I want to be in the NASDAQ area. I want to be in the tech play, but I also want to look at different ways to hedge myself to play some of the market movement that may be coming down the pipeline here over the next couple of weeks.
And, what do you guys think? What does everybody watching? Leave us a comment, leave us some questions. Anybody watching live, feel free to do so. And speaking of which, Brian, you got a question. You made a trade on Tesla a couple of weeks ago. We got a question from Kyle out there. He wants to know, what are you doing in Tesla post earnings? Are you buying Tesla here? Are you selling a put, or are you just staying away?
Yeah, we played a bearish trade on it. We got it kind of right. We stayed protected on Tesla. I think we're in a very gray area for Tesla right now. The stock broke below a very critical support level of 200. I sold positions in there. And so right around this 189, 190 level, I think, could you play it short? Maybe it's a little bit oversold to the downside at this point. But I think in this call it 88 area to 200 is an area to be a seller in Tesla, whether you're going to use options to buy puts or not. And then keep a tight stop. I think if it can get it back above 200, it could really give the market a pretty big downward head fake to the downside and catch the shorts off guard. And then all of a sudden break above 200 and try and get back to that 220 level or so where it was trading before earnings and before, pre-earnings when the stock first started selling off. So there's been a lot of a flush out here. You got to be a little careful. But right now, this is maybe a stay away until I see better times ahead.
That makes sense to me. We got, the news from Musk saying he's not sure about the AI in Tesla, might want a larger ownership stake in the company. That might be some selling pressure. Just kind of wait and see what happens over the next few months for me. Makes a lot of sense. All right. Let's move it over to options 101. Options 101.
So here we are, Equity Armor Investments, Option 101 plays, sponsored by the MIAX on Market Matters. Joe, what do you got for us? You're buying a put, or you're teaching people on how to buy a put and what it does.
Yeah, so bottom line is people can buy a put. They can profit off of a stock by going lower. People can also buy a put to protect a long stock position from extreme losses. Now, the two considerations you have to make is when you're buying a put is how long a duration am I looking for, and how close to in the money, or how close to where the stock is trading now, I'm going to put that put. Now, the closer to at the money, or even in the money, the higher the premium will be, and the longer dated put that we select, the higher the premium it will be. So we have to take all that into consideration. But real quickly, let's just take a look at what it looks like Protecting against a long position, you can sell a stock, or to profit off of a stock going lower, you can short a stock, which the P&L looks exactly like this. And or you could buy a put, in which you get a similar downside P&L minus the premium that you paid, and you have a maximum loss. If the stock does raise higher, you're limited to the loss of the premium you put out for the put.
Awesome. Well, that's our Options 101 play for you. And that basically concludes our show for Market Matters here. We've had a great show. We've got a big week on hand. We'll give more updates next week. Please tune in every Monday, 1 p.m. Eastern. You can join myself, Brian Stutland, my colleague Joe Tigay here. We'd like to thank the MIAX for sponsoring the show and Tradier Hub for putting this on. We'll catch you next week.
Good to see you.